geopolitical conflicts continuing. You all know there were significant pressures on the margins overall on the back of both China capacity, weak demand. I think the clear standout is when you look at the overall numbers, the fact that ours has been a more domestic focus. If I start with each of the businesses, obviously with O2C, we saw strong demand growth. You have seen it in gas oil, you have seen it in gasoline, you have seen it in ATF, you have also seen it in polymer, polyester. Oil and gas demand has been good. Retail has been actually in some ways mixed. First half was slow. Also, if you recall, we had 3 full quarters of significant streamlining and rationalization that we did, and beginning last quarter, and more importantly, this quarter, you can see the pickup in EBITDA. And second half also benefited from Mahakumbh and festive demand. Jio is a very strong performance, customer additions, 5G subscribers, the ARPU going up, and we didn't lose customers or we didn't lose the intensity of data consumption too. The full year, if you look at it, energy, when I say energy year, I've taken O2C and upstream as part of the 8% number. We saw that weaker cracks, polyester, to a great extent negated by a lot of things that we did on feedstock optimization. Domestic push has been a big standout, and I have few slides on A, our market share, and B, what has been the growth in volumes there. Overall, I think the other point I would definitely flag is when you look at the O2C or energy performance in the context of how other global refineries have performed, or standalone petrochemical manufacturers, or even actually integrated players. If you see the numbers, it is absolutely standout in terms of our performance. On Jio EBITDA, so that's how EBITDA was lower by 8%. Jio Platforms up 17% on the back of course, the leadership in technology, the number of customers add, the ARPU increase, and now we are the world's largest data company and have 191 million 5G subscribers, and ARPU million 5G subscribers, and ARPU at 206 rupees plus at 13.5%. On retail, I talked to you about the first half being soft and all the efforts on streamlining and rationalizations of stores, etc. And from the third and fourth quarter has been pretty good, and also all the operating metrics in terms of transactions, in terms of number of customers, all of them holding pretty well, and a lot of focus on quick commerce. And Dinesh will talk to you about what we are doing on quick commerce, and of course on Jio Star, which with effective date was somewhere in November. It is the largest media and entertainment company in India. We have, again, I don't want to steal the thunder of Kevin, but 280 million subscribers. And I think I just like the statistics on 61 million live concurrency. I think it means a lot in the context of what you have seen even globally. And Kevin, do talk about this when he present. So these are the overall numbers on a full year basis. Revenue up 7%. But obviously muted on EBITDA and PAT, and we talked about O2C's performance there. When you look at each of the, obviously the consumer business fully offset the weakness there. When you look at the PAT numbers for each of the entities, you can see JPL at 26,000 crores, it's up 22%, and RRVL almost 12,400 crores, up 11%. RIL standalone impacted because of O2C. Here is the balance sheet. So it's been a flat net debt environment. And you look at the capex versus our cash profits, clearly we continue to be below, and all the numbers are pretty healthy there and allows us to invest. And just for the quarter, revenues were up about 9% and EBITDA 4% up, and again PAT 6.4. Here, the broad story on margins, and when we talk about O2C, we will see that there has been this broader compression on deltas across transportation fuel and polymer, and also maybe not on the polymer side, definitely has been weak. And big offsets with Jio we're up 18% and retail up 14%. Oil and gas was impacted with lower production. With this, Anshuman, this is
Thanks, Shrikant. Good evening, everyone. Welcome to the physical analyst meet. An update on the performance of Jio Platforms. Strong revenue and EBITDA growth. This was a combination of both the tariff impact flowing through, but in addition, a lot of success that we're seeing with our home broadband rollout, both combination of fiber, but more importantly, fixed wireless, and I'll speak a bit more about that. Consolidated operating revenues for the full year at 1,28,218 crores, and EBITDA at 64,170, so roughly around 17 to 18% growth. And for the quarter, the consolidated revenue was very close to 34,000 crores. The total subscriber base at 488.2 million, so that's a net addition of 6.1 million for the quarter. So, the little bit of impact that we saw a couple of quarters ago when tariffs were raised, well and truly back. Is behind us, and we are now adding subscribers. We're seeing good traction on the ground, and also seeing very good consumption trends on the ground. Who's at 206.2 rupees, so a little bit of flow through of the tariff increase, and also some bit of more data consumption in this quarter. Data traffic on the network grew 20% year on year to 49 exabytes in this quarter. So that we continue to break all records for data consumption, and this is not only Indian records but global records. The growing 5G subscriber mix, as well as the competitive tenders for government clients. A whole lot of initiatives leading to this strong financial and operating performance, and I'll speak through some of those. Mobility, our lead, our success in the 5G deployment, and now 5G consumption and customers' uptake of 5G is very clearly visible on the ground. This map from Ookla shows again we have pretty much pan-India 5G coverage now. We cover most of our customers, and we have been able to transition 191 million users to 5G, which is the largest base outside of China. And if you recollect the last quarter itself, we had spoken about how we are now the world's largest data company in terms of overall data consumption, and we continue to be that ahead of companies from China as well, bigger than China Mobile. 5G traffic as a percentage of total traffic has been growing. So we are now at 45% of total wireless traffic is on 5G. And this continues to grow, and the data consumption is continuing to grow, and we're seeing the per capita consumption for consumers when on 5G network is significantly higher. So people are finding the usage to use more data, and we believe that's sticky kind of usage, and that will give us the ability to monetize that more as we go forward. We've really not started monetizing 5G. So effectively, 45% of data that people today are consuming is being offered to them free of cost. They become eligible to use that data, but after that, they're not really paying for it. But they're getting into the habit of consuming content, consuming data, consuming 5G services. And we believe that's a very big opportunity for us in the same way that LTE was a big opportunity for us in 2016. The fact that that differentiated LTE gap, LTE data capacity creation that we had done, which subsequently led to the revenue market share, finally it has to reflect at some point in time. We're seeing a similar trend now beginning to emerge here, and we see this as a massive opportunity as far as wireless services are concerned, and even home broadband services are concerned. And at these scales, where 191 million users, 45% of data traffic on the network, we are able to give 224 Mbps 5G download experience. The overall download experience across all the tests that we do and then external agencies do external agencies do. They have all been very positive. The customer user experience has been extremely positive on the 5G network. Despite the growth in traffic, we have been holding up quite well. A case study, an example of that was the Mahakumbh, which I'm sure all of you are familiar with. This was over 660 million devotees gathering within 40 square kilometers in 45 days. And the way our network held up, and we did put in a lot of effort to make sure that the network held up during those 45 days in the Mahakumbh. You know, it was the densest data consumption, population convergence that anybody had ever seen globally. We were working with our vendors, with our partners, and they were tracking the data usage as well. And it was mind-boggling for all of them. Nobody anywhere in the globe had ever seen something like this. There were limited access zones, there were jammers put all across, but we still had to make sure that people were able to consume as much data that they wanted, and they were online all the time. And you know, a big difference we saw here, the uplink traffic used to be quite high. So a lot of people were uploading videos and pictures, and normally that's not the way you plan your network. You would expect downlink to be much more. And we had to therefore adjust some of this there on the ground, on the site. We were able to with our spectrum that we have, but the government had given us some spectrum during that period to just provide services to the customers. We were able to, you know, test the elasticity of that network really in that small period or small space where we saw 2.2 million GB of data traffic. You know, 5G was bulk of the usage of 5G. So the whole area was enabled with 5G. We were giving download and upload speeds of 200 Mbps plus 141 million voice minutes. So this has kind of become a case study for network companies, telecom companies, service providers, vendors. Everybody is looking at this as a case study where these kind of global records were set in a short period of time. And we learned a lot to now sweat the assets on our network much more, the deployment that we have already done, plus with the spectrum that we have got, the network is fairly elastic. We can keep adding more customers with tweaks to the network, being able to track where the data consumption or where the consumption is, where the users are. The elasticity of this network is fairly high. That gives us confidence that with the network that we've already created, we can serve, you know, hundreds of millions more on the UBR. We have developed or now deployed, not only developed, so it's in commercial use, the first point-to-multi-point wireless solution for fixed wireless. So this is not point-to-point. We can, in the way the network is configured, we can use single radiating equipment to serve multiple customers. We have been able to, through that, reduce the cost of deployment. So the cost that we incur to connect every new home is incrementally much lesser than what you would hear about companies elsewhere which are doing such a thing. The spectral efficiency is higher. And, you know, we've been able to create the full mapping of the country where our customers are. This is a very important functionality. So when we get a customer inquiry or a customer request to connect a customer, we know exactly which way, which technology to use, which site to radiate from for a particular customer. If the fiber is available, of course, we connect the customer with fiber. But otherwise, with our 5G spectrum, in some cases UBR, we know exactly it's pretty much 1 meter by, or 3 meter by 3 meter map, where we know exactly what kind of throughput different technologies will provide to customers. And that's very powerful on the ground when the implementation is going on, when the network engineers have to be on the ground connecting new homes and new premises. And all of this is being done completely end-to-end value chain is in our control, be it the devices, the technology, deployment, all of that has been done in-house. So we are not taking this technology or taking any equipment from. Now, pretty much all the equipment is being manufactured, produced by ourselves within the ecosystem. They've been designed ourselves, and they're being produced in India. All of this is made in India and being done completely within the Jio ecosystem. As a result of which, we are feeling confident to be able to connect 100 million homes, which is a target that we've set for ourselves. In the last few months, we have been in the last 6 months, we have had 90% of industry net adds, 5x higher than the next nearest competitor. So the chart on the right top that you see is the number of AirFiber subscribers, basically the fixed wireless subscribers. We call it AirFiber because unlike the traditional definition of fixed wireless, In our case, we are giving completely synchronous uplink, downlink throughputs because of the way the network is configured, because of the spectrum that we are using. So when we say 1 Gbps at home for home broadband using either our 5G spectrum or our or the UBR, that's uplink and downlink of 1 Gbps. That's what we have enabled, and which is reflecting in the way in the ramp up of AirFiber subscribers. And in the recent months, we have also transitioned from the 5G spectrum to UBR. UBR is now commercially live, even in situations where we don't have direct line of sight, which has been a big challenge for just about every operator globally. We are able to do without non-line of sight connections as well by reflecting the radios from some other surfaces. This is unique, this is proprietary, and we have been doing this successfully and commercially. So it's all commercially deployed on the ground. The chart at the bottom is not supposed to be Pac-Man, but we are fairly, you know, we have good lead over the others in the industry. This is the other deployment which is now being done successfully commercially on the ground, which is our private 5G instances for enterprise customers. As you can see, the network is the same, but we are able to create a dedicated slice for use cases, for enterprises, for you know, whatever the end use case may be, including for fixed wireless. We have a network slice that we use to provide that service, and then create a secure tunnel on this our own private 5G core. As you know, we have spoken about this in the past, that our 5G core, the whole network core, 4G and 5G core, is completely deployed by us. It's our own proprietary core, and we are able to create private instance of that for our enterprise customers. And this has got many use cases. We already have deployed in some of the industrial situations, industrial premises, including in Jamnagar, and you know, use cases around robotic automation, video surveillance, enhanced security. We are able to give ultra reliable, low latency network. I think I've stepped on something. No. We are able to do network slicing to ensure consistent service delivery, irrespective of the amount of load that the network may have at any point in time, and able to provide end-to-end managed services. With those few updates around stuff that we're doing on technology and the progress we have made over the last few months, especially on 5G and the home and home deployment, coming to the key operating matrices for the business, the subscriber base 6.1 million during the quarter. The ARPU went up to 206.2, and remember, this is a shortened quarter. So in that sense, the growth is a little bit more than that in percentage terms. The average data consumption continues to grow, 33.6 GB per user per month, and seeing a lot of traction as in these seasons currently as well. Overall data and voice traffic grew by 19.5% and 3.8% year-on-year respectively. Coming to the revenue numbers, these are the RJIL quarterly financials, which grew to 30,018 crore in terms of revenues and 16,188 crores in EBITDA. That is close to 54% EBITDA margin for our connectivity business, and the growth has been fairly steady and continuous. And the full year numbers for the connectivity business, RJIL, we ended the year at 1,14,000 crores of revenues, operating revenues, and EBITDA of 61,233 crores. So both growing in the 14 to 16% range, and again fairly steady and healthy growth delivered across the years over last several years. The consolidated financials for Jio Platforms Limited, the first three columns are quarterly, and then the full year numbers on the right two columns. Full year fiscal 25 revenue and EBITDA growth of 17%, consistent EBITDA margins of 50%, and this is, you know, after a whole bunch of initiatives that are currently being taken to grow our digital services, our other service offerings that we are going to provide to customers. We are maintaining our EBITDA margin at 50%. Q4 revenues at 33,986 crore consolidated revenues, which is again close to 18% year-on-year growth, and EBITDA at 17,000 crores, and profit after tax growth of 26% to 7,023 crore. This was for the quarter Q4. With that, I'm going to hand over to Dinesh to give an update on the retail business.
Hi, good evening, everyone. We'll cover the business update on retail. So if you look at the performance highlights, we had a very strong quarter with 16% growth on a YOY basis. The revenue for full year was up 8% because the first half was slightly weak. But the second half, last quarter was good growth, and even this quarter we have done very well. Overall, EBITDA grew at 9% for the full year. For the quarter, it was 14%. EBITDA margin from operations continues to expand. It was up 20 basis points on a YOY basis. On the quick commerce side, we continue to expand our hyper-local deliveries. The number of orders were up quarter on quarter 2.4 times. So that's a pretty significant scale up that we've been able to do in the last quarter. Consumer brands business is the fastest growing FMCG business in India. We have achieved almost 11,450 crores of sales in the second year of operations. We also did the commercial launch of Shein with the vision of providing global fashion to every Indian at affordable prices. It's live across app, website, as well as we have a shop-in-shop on Jio. More than 12,000 options are already available on the platform, and we are scaling up the vendor ecosystem to have very quick and launch very quickly large number of options on the platform. We opened 2,659 stores during the year. We continue to expand stores across the portfolio. We are also pretty much done with the streamlining that we had started during the year. So our net addition is about 500 stores. And we are pretty much more or less done with the streamlining now. All our operating metrics, whether it's number of transactions, the registered customers, everything continues to grow in double digits. So overall, a pretty healthy quarter. If we look at the breakup, revenue was up 16% for the quarter on a YOY basis. EBITDA from operations was up 15%. Total EBITDA was up 14%, and profit after tax was up 30%. When you look at it on a full year basis, the revenue was up 8%, EBITDA from operations was up 9%, and profit after tax was up 12%. So we've almost crossed 25,000 crores in EBITDA for the full year and 12,400 crores of PAT. Moving on to business updates across each of the businesses. The consumer electronics business, we had pretty healthy, mid-single digit like-for-like growth. The average bill values continues to grow. The average bill values were up 26% on a YOY basis. Also, we see our conversions improving substantially. There was a 200 basis points improvement in conversions. With the early onset of summers, we saw very strong growth in sales of ACs. Even this quarter, April has been pretty warm, and there's a prediction of this being a pretty hot summer. So AC will continue to grow rapidly. Our rescue business, we had a 13% increase YOY on the growth of in terms of the number of customers served. We also continue to expand the number of service centers we have, as well as we launched the on-demand warranty services last 3 quarters back. So that's again something we are expanding. We are now we've launched out on-demand warranty services to more than 300 cities. GMD, which is our B2B and B2B2C business in electronics, it had a very healthy growth of 76% on a YOY basis. We continue to expand our reach in terms of the merchant base, as well as expand the width of participation, right? So how many retailers are participating, how much they are buying from us, all those metrics are showing a pretty healthy upswing. Our own brands business, where we sell our own brands, not just in our stores, but even in the distribution channel. That business again continues to grow very steadily. The business was up 30% on a YOY basis. We are expanding the reach of the business. We have the merchant base was up 60% on a YOY basis. We launched several new products across multiple brands, multiple categories to plug the gaps, as well as new features. There are some products where we are bringing new features to the market. These are the first in the market, and compared with the price value proposition, they are finding very strong uptick with the consumers. On the fashion lifestyle side, while the first half was weak, the business has really turned around very well. We had positive LFLs during the quarter. The performance was quite steady, led by the wedding season and festivals. We have been working on, repositioning the some of our formats. So trends, we did a large campaign, new times, new trends, to really reposition the format within the younger audience, as well as the family audience. Azort, which is a Gen Z focused, tech enabled format. There we again did a targeted campaign with a couple of celebrities. So the effort is to establish these brands and have top of mind recall for the Gen Z customers. In addition, we are upgrading our stores. So Trends 3.0, which we have talked about, which is an upgraded version of a Trend store, a more digitally enabled version. So that's something we are scaling up. We are renovating a lot of our stores to upgrade them to have the latest technology, and also support that with better in-store experience, not just in terms of technology which is available, but in terms of number of options people see. So we have moved on with Project Impetus, which we have talked about in the past, where we are talking of a design to shelf cycle of 30 days. We are now doing weekly refreshes in the store. So every time a customer walks in, they get a certain percentage of options which are new. Also, we have kind of optimized the number of options which are available, so the stores are less crowded and they look much more attractive. Now, as a result, our sales are going up while the inventory is going down. So that's a very good sign for the business. We have also spent a lot of effort on improving the design quotient of our products. And our own brands, the contribution was up 900 basis points on a YOY basis. Specifically, some of our large and well-known brands, including Netplay and Avasa, they were the best performers during the quarter. Moving on to our online fashion businesses, Jio delivers had a very healthy quarter, steady quarter. We continue as well as add new customers. We added 1.9 million new customers during the quarter, which is in line with what we have been adding almost every quarter. The number of options available on the platform now is 2.4 million, up 44% on a YOY basis. External brands are the ones which drive traffic onto the platform. So their share was up 11%, and our focus continues to be bring more and more exclusive and external brands which we are able to get the customer pull and drive traffic onto the platform. We've also launched same day and next day delivery across 26 cities. So we are increasing the speed at which we are able to deliver the products. One big benefit of that is returns goes down, and we are seeing that very clearly in our data. The All-Star sale, which is a flagship event for March. In March, most of the online platforms go on sale. This is the time where we acquire a lot of customers. We had a big event and we added 6 lakh plus new customers during this campaign. We talked about the Sheen launch, which we have done during the quarter as well. On the premium brand side, the focus is growing the omni-channel presence, especially, a lot of luxury and bridge to luxury brands. Customers don't necessarily always prefer to come to the store. They want to come to you. So there's a meaningful 8% contribution that is coming from out of store selling, right? So where basically we're going to the customer's home or letting them order online, and then we are delivering to their homes. So that's seeing a very good acceptance amongst the customers, and this part is becoming quite meaningful. We launched another very interesting, accessible luxury, ready-to-wear women's brand, a French brand called Moj, during the quarter. We have launched our first store in Jio World Drive. On Vision Express, which is our JV with EssilorLuxottica in the eyewear space, we've kind of repivoted the go-to-market strategy. We are launching global new concept stores, as well as renovating a lot of existing stores and the product offering in order to really scale up this business. There's a large market opportunity here. Jio Lux, which is the premium, which is the largest platform for luxury and premium brands. We continue to add new brands and new options into the portfolio. The total count of brands now there is about 800. The options was up 19% on a YOY basis. On the jewels business, we had steady growth led by increase in average bill values. As you are aware, the gold prices have increased substantially, which has had an impact on the average bill values, which are up almost 20% on a YOY basis. Our differentiator has been launch targeted campaigns, which the targeted product, collections which target specific occasions, right? Design-led offering that continues to do well. We have developed a number of properties over the last several years, and some of those collections like Valentine's Day, Hoops and Bali collections were very well received during the quarter. Grocery was the star performer during this quarter with the highest growth. The stores business continues to outperform with industry-leading performance. Some of the premium formats, including Fresh Pick and Go Fresh, where we provide differentiated assortment and shopping experience, are finding very good acceptance. And in the affluent areas, we are launching more and more premium stores. The growth was quite broad-based across categories. The general merchandise and value apparel have a meaningful contribution, especially in our big box stores, and they are a big driver of margin. Also, there's more strong demand for niche and premium products. These are the products which drive a lot of footfall into the stores, especially the younger customers, because these brands are not available anywhere else. We are able to take them pan-India, and it's a win-win for the brand as well as for the customer. And for us, it drives a lot of traffic, especially the younger ones, into the stores. The B2B business, Metro, continues to have steady growth, again, pretty broad-based growth across categories. One of the segments that we have identified within B2B is the HoReCa segment, where we are putting a lot of focus. That segment had a 37% growth on a YOY basis. JioMart, it has basically three services. There's a under 30-minute quick service. There is a scheduled delivery where the assortment is much wider, and then there's subscription service where you can subscribe, and every day you get, depending on the frequency you choose, we deliver the goods at your home early morning. All three are picking up very well. The average daily orders were up 62% on a YOY basis. Specifically our under 30-minute offering, which is the widest, which has the widest network reach. We have almost 2,000 plus stores which are on the network, covering more than 4,000 plus pin codes. So this is much wider reach than any other quick commerce player. We have kind of repivoted our model completely to under 30 minutes delivery, and we are seeing very strong traction with a 2.4x quarter-on-quarter growth in daily exit orders, and this number will scale up substantially in the coming year as well. We are also now starting to proactively market this proposition. Our proposition of no hidden charges, quick delivery, and no delivery fees continues to work very well, resonate very well with the customers. We also launched the quick and scheduled tabs. If you go to the JioMart app, there are two separate tabs, so that customer is very clear what is available under 30 minutes, what is available. So that assortment under 30 minutes, if you want, there's that assortment which gets delivered from the nearest store. That is what you see. If you choose scheduled delivery, you get a much wider assortment, and you can get the delivery for those the next day. They may come from a warehouse or from a 3P seller. So that proposition is very clear for the customer. The big advantage that we have in this segment is compared to other people who have to set up dedicated store infrastructure. For us, we are only leveraging the infrastructure that we already have. My fixed cost is already being taken care of by my store sales, right? This is all incremental sales, and it's only incremental cost that I have to incur to deliver these orders. So we are doing this model in a profitable manner with a very strong unit economics. In addition to our 1P offerings, 3P seller base, in order to plug the gaps, we continue to add 3P sellers onto the platform. The number of 3P sellers was up 22% on a YOY basis. Live selection was up 10% on a YOY basis. Similarly, our subscription service continues to see strong growth. We had a 27% growth YOY on daily orders and 37% growth in apps and web visits. Consumer brands, it's on a very, very exciting trajectory. The business is growing from strength to strength. We did almost 11,500 crores of turnover during the year. More than 60% of that comes from general trade. So it's wide. The brands are very, very, very widely distributed. If we look at some of our key brands like Campa and Independence, they are all growing very rapidly. Campa has already gained double-digit market share in the key markets where we are available. We are also continue to add to our portfolio by launching new products and acquiring new interesting brands. So some of the notable acquisitions we have done in the year include Sil, Velvet, which is a personal care brand, and Tags. We have also launched several new products. So with Campa, we have launched Campa Energy, and with Mutya Muralidharan, we have launched a new sports drink called Spinner. Our distribution network is already quite wide, and it is expanding pretty rapidly as well. We are present across 1 million plus retail outlets through a network of 3,200 plus distributors. In addition to tapping the Indian market, we have also started looking at exports to other markets. And we would basically started that, and we would set up distribution in select markets to really distribute our products where they have the relevant appeal in a pretty big way. That's the update on the retail business. Now I'll hand over to Kevin for the JioStar business.
Thank you, and good evening, everyone. Our business at JioStar is barely 5 months old. So what I'm going to do is I'm going to share with you what we've been up to for the last 5 months. I hope each and every one of you all have downloaded the Jio Hotstar app and are enjoying it. Just to give you a perspective, I'm seeing is the coming together of two iconic brands, Viacom 18 and Disney Star. And on today's date, we've created India's largest media and entertainment platform. This platform is built on 3 business units: the digital entertainment business, the sports unit, and the TV broadcast. I'll talk through to each of them. If I look at the digital entertainment platform, within a short period of 3 months, we went and launched Jio Hotstar. The merger got completed on November 14th. On Feb 14th is when we went and launched Jio Hotstar. And we transferred a robust library of 320,000 hours of content onto the platform. In addition, we added 250 originals or exclusive titles, which is the highest among any of our contemporaries. And thirdly, and most important thing is, this will be the only platform in the world that would have all the biggest American studios to be on a single platform, where you'll have their movies and series coming on one single platform, whether it's from Marvel to HBO, whether it's Warner to Disney, or it is Peacock to Paramount. You'll have all the content on a single platform. This platform of ours, when you look at the width of content that we have, actually appeals to the entire family, okay, across India. And more important, it's not about reaching out to families across India, but within a family, we have content for each and every individual, whether it's kids, where you have 2 iconic brands, Disney and Nickelodeon, or for the youth segment, where we have some of the biggest reality shows or non-fiction shows, whether it is Big Boss, whether it is Khatro Ki Khiladi, Coffee with Karan, or Laughter Chef on a single platform. For the women of the household, we have got some of the most iconic brands, whether it's Anupama, or I'm seeing is, if you look at it, it's Mangal Lakshmi, okay? And then for the males, we've got a whole lot of sporting. If I look at our sports portfolio across TV and digital, we have around about 24 sports channels. And in today's date, we are the home to the best marquee properties on cricket, whether it's ICC, whether it's IPL or BCCI, but also home to the biggest domestic leagues, the Pro Kabaddi League or the Indian Super League, and also high-end sports or premium sports, which is the Premier League and Wimbledon. Lastly, on the TV broadcast business, we have a very robust TV broadcast business with over 100 channels in 10 different languages, actually reaching out to around about 358 million viewers every day. If I look at it between these businesses, we reach out on a monthly basis to over 800 million people every month. So I spoke a lot about, I'm saying is entertainment, I spoke about sports. But we at JioStar look at creating delightful experiences for our consumers. And on the 26th of Jan is when we started bringing up live experiences, where we started streaming live shows. Coldplay was one example. 100,000 people enjoyed Coldplay live at the Narendra Modi Stadium in Ahmedabad. What Jio Hotstar managed to do is to take this to millions of fans to their living rooms and let them enjoy the same live experience in their living room across the country. Besides that, I'm saying is we've gone and done two big events on Mahashivratri and Ram Navami. And if you look at the numbers for each of these, right, we looked at 82 million views coming up for Ram Navami. We had Ram Navami, which was through multiple feeds. So people could view the Aarti through multiple feeds, not from a single location. At the same time, they could see something in Ayodhya, Chitrakoot, or Panchvati. So now I'm seeing is all this content, what does it deliver for us? I spoke about the width of the content. These are the numbers. Okay. Within a short period of 3.5 months on today's date, we have got 280 million paid subscribers. Actually, we put this in perspective, we are very close to, I'm seeing is globally, very close to the number of Netflix, which gets this from across the world. We generate, I'm seeing is, we have 503 million, I'm seeing is users who come to our platform on a monthly basis. Significantly ahead of any of our competition. And lastly, as Srikanth was mentioning, if I look at during the India-New Zealand final for the Champions Trophy, we managed a concurrency. And when I'm saying concurrency is people coming and watching at the same time, right? This is a world record where we have 61 million people watching a sport at the same time. And that shows the strength of the platform. If I have to put it into perspective for you, many of us might know of the Super Bowl in the US. Let me tell you, their peak concurrency could be 1/4 of it. And I think this shows that people, in spite of having 61 million, we had a seamless, I'm seeing is viewership for each of these consumers that came on. On TV, we've got a 34% market share, and a content library of 320,000 hours of content is actually 6 times that of a Netflix or an Amazon. Just from an operational point of view, we launched, as I mentioned, we launched Jio Hotstar app with the best features from both the apps, from both the legacy apps. We seamlessly migrated 500 million plus users and a massive content library within 3 months. In TV, we lead in 7 out of the 8 markets. Whether it's TV, mobile, or CTV in this country. On the back of IPL, many people talk about pay television dying in this country, etc. But remember, in this country, pay television is still in excess of 100 million and still growing. During the IPL, in the first 10 days of the IPL, right, we grew by around about 1.5 million households, and we expect that to hit at least 3 to 5 by the end of it. Lastly, I'm saying is that's all what doing this to just translate it. What does all this mean into numbers? The biggest part was this merger was consummated in less than 9 months, a merger of this scale. Our revenue, if I have to look at it for the period, and I've taken, because it's a very short period, I've taken from the time we launched, is 9,497 crores with an EBITDA of 266 crores. We've had a robust financial performance, keeping in mind, in spite of the weak macroeconomic situation that is there. We've had higher sports revenue led by ICC Trophy as well as IPL. And despite the headwinds, we have kept a very close eye on our costs and to ensure that we have profitability and have positive financials for this period. Thank you. That's all from my end. I shall now hand over to Sanjay.
Good evening, everyone. Thanks, Kevin. All right, just to recap the performance for the year gone by. So this has been by far the strongest year in terms of
performance from the oil and gas business. If we look at the year-on-year consolidated EBITDA, it's been almost 1,000 crores higher than the previous year, which had at that time set the best performance. The EBITDA margins still remain very healthy at 84%, largely driven by higher production, 4% production from KGD6, as well as stable prices. We did have the benefit of $10.16 as ceiling price in the second half of the year. As well as in CBM, we have completed the first campaign of the 40 well multilateral wells, and that has augmented production. We've now are seeing a turnaround in our CBM business. It had been declining for quite some time, but now progressively the production keeps increasing with the wells, the multilateral wells, which has been an innovation of sorts. It's the first time horizontal multilateral wells have been done in India and successfully deployed in the field, and we are getting significant upside in production. You know, we were looking at about 4,000 standard cubic meters of gas production from the verticals, but we are seeing about 12 to 13,000 now. So that's really the benefit we are getting out of these multilateral wells. This is a recap of the last quarter, the quarter gone by. Again, the quarter was a little bit more muted as compared to the first three quarters, only because production from KGD6, there was a little bit of natural decline on expected lines. But more importantly, we had to undertake a lot of maintenance activities towards the end of the quarter. One of the things is we thought, let's complete these activities, particularly the FPSO had to take a shutdown, planned shutdown for undertaking these maintenance activities. But now all the wells are back up on stream, and we are back to ramping up the production to about 28 million standard cubic meters. Similarly, CBM, we have commenced the second campaign, so the production from those will also be seen as we go along. Overall, if we look at the price realizations in KGD6, it's been slightly better year on year, quarter on quarter, and in CBM it's been slightly lower, again driven by the Brent prices. But nevertheless, you know, the positive aspect about CBM is that it doesn't have a price ceiling, so you get market-linked prices. So how does the global gas market look? You know, I think largely we have seen prices hover in the range of $10 to $14. And what we have seen, this is mainly, there's been a push and pull over there in terms of supply and demand. On one end, because of potentially weaker economies, we have seen, you know, the demand being a little tepid. But at the other end of the anvil, you have Europe, where the inventory levels are much lower. So the refill is a focus area. India demand remains robust. I'll talk about it in the next slide. But going forward, also what we had expected is the LNG glut to come in. As you may be all aware, about 150 million tons per annum of LNG was expected to be brought online from end 2025 onwards, and progressively over the next 2 to 3 years. So we expected there might be a strong pullback in prices, but seeing the delays, again, the Biden administration had to that extent about 20 to 30 million tons per annum of projects were put on hold. And the other projects have faced regulatory delays, like in Corpus Christi and some of the major projects, also in Canada. So we feel that it may not be as exacerbated as we had anticipated. It may be, you know, the projects may come online, but it should get the gas outlook being what it is. The demand, particularly in the developing nations, would be such that it should be absorbed well enough in the next 3 to 4 years. So that's really the broad outlook. And so going forward, you know, we think we should be in steady ground for gas prices. There will be some amount of volatility, but we feel from an Indian market standpoint, it should be all right. So just to give you a recap of the Indian gas market, it looks pretty strong. The demand has been up by almost 4%, largely driven by city gas distribution and some of the petchem expansions. And again, it's the city gas distribution, both in terms of expansion and penetration. So that's largely contributed out of the 8 MMS CMD, nearly 4 MMS CMD has been driven by CGD. We are also observing a trend that the LNG markets, the long-term contracts are being pursued rather than short-term. So essentially the gas for the longer term, the demand looks pretty strong and vibrant in India. The ceiling price also, as you may be all aware, is now being revised to $10.04. We are contracted for the volume, so we are all right there. Thank you, and I'll invite Shrikant. Thank you.
So, starting with the financials, EBITDA lower by 12%. You'll see the slides, but anything from 36 to 41% fall in transportation fuel, and between 2 and 13% when you look at polymer and polyester. Clearly led by Chinese capacity, slowdown on demand. To a great extent, there was some offsets coming because of the fact that India demand was good, 7.5% for gasoline. ATF was about 9%. Both polymer and polyester demand up 5%. We placed a lot through Jio BP, and I have in the subsequent slide I'll talk through about how impactful it was overall. Also, we also benefited from operational excellence. This was the highest throughput that we have done in this refinery. And then, of course, the continuing benefit from cost optimization, ethane cracking economics worked well. And this is the slide. This tells the full story on gasoline, gas oil, and ATF. When you look at year-on-year change, and you look at where it was vis-a-vis 5 years, anywhere between 25 to 27% lower in the case of gas oil, gasoline, and ATFs about 13%. The reasons are known in terms of demand, and both China, EU, multiple places. Driving season was slow in the US. Similarly, when you look at on the downstream petrochemical side, naphtha was up 4%, but ethane prices were lower by 9%. So that benefited us because the deltas were squeezed when you compare it to naphtha. But PP, PVC, tell you the story of what a 15, 20-year low means in terms of this environment. So it has been a more difficult one. Again, capacity additions primarily the big driver, and then of course demand also being soft. So this is what I was saying in terms of what helped mitigate this otherwise difficult margin environment, whereas volume growth in Jio BP, you can see 35% higher. When you look at MS and HSD, ATF up about 62%. Of course, e-mobility is small, but you can see the jump in percentages there. And even if you look at our market share now with in motor spirits about 3.3, in gas oil about 5.2, and importantly the effectiveness that you see, the market effectiveness, you can see the score per retail outlet. You can see that the effectiveness of each of these pumps is very strong. So it's 1.6, it's 2.6 actually in the case of HSD. So, and this is something that we would continue to expand, in the coming year or more. It's 1,916. There is no reason why it has to be this level. It can be much higher than that. This is the throughput I was talking to you about, highest ever at 80.5. Overall, all the products. So this 2.5% benefit did help mitigate this margin environment. Overall, you look at the throughputs were absolutely maximized in platformers and FCC. The aromatic production that optimization always happens, that we continue to do, focused on high octane exports, because from the value point of view, and continuing benefit from gasification helped the overall performance. And this is just the numbers for the quarter. Again, story not very different in terms of margins being weak, but there were some offsets. While fuel was down between 27 and 55%, and the whole polyester chain was down, you did see some offsets in the form of polypropylene slightly higher by 4%. PVC helped at about 13%, and then the whole PBR, SBR about 10 to 15%. So also, as I mentioned, processing, the whole focus obviously was also on processing the right value of crudes, trying to derive advantage from the value adds coming from crude processing. Domestic placements continued as a point. Some small lift from sulfur prices, which really went through the roof. And, some benefit of exchange rate when you look at it from a rupee point of view, rupee earnings point of view. This I will not spend too much time. The broader environment. Brent did come off on a year-on-year basis on concerns on tariff, etc. Of course, on a quarter-on-quarter basis, the story on ethane was higher because it was up 42% overall versus last year. But overall, having said that, still the cracking economics were pretty favorable, and both the refining operating rates and the cracker operating rates were fairly stable. When you look at the demand environment, it rose by about 1.2. Primarily, geographically, if you see, it is in Asia by 0.4, and OECD America is another 0.4. When you look at it from a product standpoint, gasoline was about 0.4 million barrels per day growth, and balance in diesel. This is you can see the stark fall in the deltas, $6 cracks versus 13.3, and China, clear reason with the increasing EV penetration, also led to some extent by inventory levels were pretty high. The fact that India gasoline demand helped, up growing 6%. So we continue to focus, as I said, on domestic placement and pushing more volumes here. And we think near term cracks could find some support. Gas oil, again, cracks, you can see a significant fall, $14 versus 23.1. Again, more led by inventories that we saw in Singapore and more exports from the Middle East. Demand, actually, if you see it vis-a-vis other products, in India, demand was up only about 1.1%. Again, the actions were broadly similar in terms of focusing on the domestic market, and corruption kind of concerns can keep the cracks at least stable here. And ATF fell in line, actually, you can say, with what we saw in gas oil. Demand for ATF has been good in India, and you saw the volume growth in Jio BP pretty strong there. And we are expecting that these margins stay. And quick ones on each of the individual products with PE. This decreased by 10%. Domestic demand has been good. Again, we're trying always to see how much can we maximize light fuel cracking here. And the drivers for domestic demand still remains good, and we do expect that to stay. On PP, again, deltas slightly up, 4%. Demand continuing to do well, and again, it's a story of domestic placement. Actually, this whole focus on domestic also plays into the same point that I said. Otherwise, if you didn't have a domestic exposure like this, I think in this environment it would have been pretty difficult. And finally, on PVC side, that improved because of EDC prices being low, and so we got a lift there in terms of year-on-year delta increase. Demand continues to be fairly good in as far as agri and infra is concerned, and don't expect too much of surprises there from a domestic demand point of view. And finally, on the polyester chain, that's a big chain for us, and it was down 15%, mainly due to decline in PX prices. And the downstream polyester prices, margins did go up, but, in the context of what happened in PX, overall, the numbers were still lower. And we continue to optimize PX versus gasoline. And overall, again, when you look at polyester demand, because of the high, if you recall, we used to always track this high cotton versus PSF, that differential remains attractive, so demand should hold there. These are projects that we had talked about, but just putting it there for in terms of 1 million ton expansion for polyester. And the difference is that it's focused on the high growth consumer and downstream market. And if you see this specifics on activewear, athleisure, hygiene, denim, so these are products which can also command a higher premium. So that's where the focus is. And then it is integrated with backward integration with 3 million ton PTA facility that is also planned. So in essence, and all these factories will be a state of the art, and it's got ensuring that the infrastructure is pretty good from an overall cost effectiveness and efficiency on capex. So it's all been, projects are there. So we are thinking about this project, and of course the next one on PVC, also to see the benefit of all this coming in 27, 28 in terms of its contribution to the EBITDA. And this is the PVC one. This is a more integrated one with caustic chlorine and EDC, both in Dahej, and then VCM and PVC in Nagotane, and then CPVC in Dahej. Again, this, as you know, is a product where India is significantly short. Even as we talk, it's a 2 to 2.5 million ton shortage, and we think that possibly it's the right time to be investing here. These are the basic updates from on the vinyl chain, and you can see some of the pictures that we have on the visuals on the land that is acquired near Dahej. And constructions commission 26-27, but financials coming in 27-28. Sorry. Yeah. Okay. So overall, this is what the focus was always on maximizing margin capture, focus on crude procurement, on getting more and more ethane, focusing on the domestic, retail sector, even as well as industrial sectors. We are trying to do a lot of things on freight cost through term charter vessels, because one aspect is that the deltas are weak, but what can we do differently in terms of ensuring that we are able to negate, if not fully, but yes, you can squeeze out efficiency. So these are things that we are focusing on. Larger, larger parcels by converting crude tankers to product services, focus on recycled PET, which we have been talking about. And of course, both the polyester and the PVC expansion should give us volume lift in 27-28 earnings. Yeah. So not a very detailed update, but just to give you, some of them in terms of the 10 gigawatt per annum capacity that we have for solar. And importantly, it is designed in such a way that, it is quick. We can quickly jump it up to 20 gigawatts. So that's an important point there. We are also focused on 30 gigawatts of battery manufacturing. So this is essentially cells to pack, and then you integrate it into a BESS system. But that's the whole aspect there. And when I talk solar, I just want to remind everybody that it is polysilicon to ingot to wafer to cell to panel, and then of course glass, and as well as POE, polyolefin elastomer. So when we say it is integrated, we are absolutely integrated on from end to end there. And the other one, so here, if you see where we are, is we have commissioned the first gigawatt scale solar module started. So we started, it is BIS certified already, and it is, I would say, the largest from a size point of view at 720 watt peak. It's possibly the largest panel that we have. So that's already commissioned. And overall, when you see in each of these on the entire solar chain, the engineering is complete, the long lead items and procurements are complete, and construction is going on in full swing. So I just wanted you to know, and this is just one part of what is coming up. And the other one is battery also will come in. We have talked a lot about renewable electricity generation, if you were to see, and what the access to the land in the Kutch region, and the land is